In this video, I'm going to analyse Royal Dutch Shell by giving my thoughts on the business, whether I personally would buy shares of RDSB right now. Just to clarify, I'm going to be talking about RDSB. That's because the variant RDSA actually has Dutch withholding tax. And since I'm from the UK, I would rather avoid that. But this can apply to all listings, including the US listed version of the stock, which would be Rds.B. Also, if you find the video useful, please consider dropping me one of these to support the channel. Royal Dutch Shell is a worldwide petrochemical and energy company, being one of the 6 oil super majors. They are listed in the FTSE 100, have 83,000 employees and a market capitalization of 117 billion euros. They operate in 4 main segments. This includes integrated gas, new energies, upstream and downstream. Upstream is the process of discovering and exploration to find crude oil, which then they would proceed to market and sell. The integrated gas segment manages their natural gas products and activities, and therefore they could then use to distribute or sell. Their new energy segment is about the exploration and investing into newer technologies that could give them sufficient commercial promise. This could be the likes of low carbon fuels or advanced biofuels. Furthermore, these could include wind and solar power, but also hydrogen energy. And the downstream segment is simply the conversion of crude oil into more useful products that are used every day. Example of these could be gasoline used in cars as fuel. We've also got kerosene, which is jet fuel, and bitumen, which is road tar. Shell is a very complex business, and I would consider their market structure to be an oligopoly, and they are in a very fragmented competitor landscape. This means that a few firms dominate a majority of the industry, but individually, neither of these firms have much marketing influence over their competitors. Furthermore, since they are in so many different industries, it's so difficult to track where they are market leaders and where they are not. Therefore, this kind of gives the argument that it's very difficult to track each and every single market without doing a very detailed analysis, which makes it different to compare to their competitors unless you do a lot more research on the matter. Regardless, if we compare the oil super majors by their overall revenue stream, we can see that Shell is actually ranked second by revenue, behind Sinopec, which is China. There's also CNPC, which is once again part of China, and then you also have the likes of BP and Exxon. When looking at the price to earnings ratio of Royal Dutch Shell, we can in fact see it's negative. Now this hints to us that they are either unprofitable, or this could be much worse, such as negative shareholder equity, although with such a mature business and a large market cap, it's very unlikely to be the case. So if we compare their market capitalization to their net assets, we can see that their price to book ratio is in fact higher than the industry, but also lower than the market, which makes sense to me, and I think this accurately reflects investor sentiment. Investors are more willing to purchase other stocks in the market, but when looking at the oil and gas industry, investors would much prefer to buy Shell, perhaps compared to some of their competitors. But this could also mean that they perhaps have a better balance sheet with less debt, and it gives us that hint also. So this is a good sign to see. And then when accounting for the oil price war back in March 2020 and also the ongoing pandemic situation, it very much makes sense as to why they could be unprofitable, but furthermore, why they may be valued less than the market. Therefore, in the last 5 years, when accounting for this extreme scenario situation, it's unlikely that they would have had a growth on their earnings. But what we can see, and if we look closely into this, that they have not only a positive free cash flow, but it remains very steady. This is a very promising sign to see in unprofitable companies. When we also consider the huge decline in both revenue and earnings in the last year, it really shows how resilient this business can actually be. Although they do have a negative profit margin of 7.6%, if we see this reversed in the future, then this shows promise as to where the company could be. Although we can also see that Shell looks very cyclical. In the last 7 years, we can see how their revenue and earnings have sloped up and down. This suggests to me that when we are in a positive economic outlook, things are looking great with the economy, then Shell will likely do well, if not grow up on their dividend quite a bit. However, on the other hand, where the economic outlook is a lot more gloomier, then Shell may not be a great investment and they may struggle significantly. Much like 2020, in which they are on a negative revenue and earnings trend, but with that comes an opportunity in which you could buy at the potential bottom of this trough and therefore sell at the top of their peaks, although I'm a long-term investor and I don't do swing trading. Shell currently has a forward dividend yield of 3.94%, typically paying in March, June, September and December. I'm using a forward dividend yield here because they had cut their dividend earlier this year and their first dividend payment has not been factored in just yet. Usually I would consider a company paying a dividend whilst unprofitable to be a huge red flag and therefore potentially avoid the investment. Shell is such a large, diverse and mature company that it won't really impact them that much, providing they are able to reverse this negative earnings trend. Whilst in the last 20 years Shell has paid a dividend each and every year, they've not really grown upon it that much. Furthermore, since they had cut their dividend in the last year, even when we look at a 5, 10 or even 15-year compound annual growth rate of the dividend, it is in fact negative. Even in the last 6 years prior to the cut, they had not grown their dividend once. However, in the midst of the pandemic, they had mentioned plans to reset the dividend and then start fresh and grow upon it. So in the future, if you invested now, perhaps this is the opportunity where you may get slightly more dividend growth, and as long as it is growing above inflation, then I could see it worthwhile for some investors. And then this also means that this money that they're saving from not paying it as a dividend, they can reinvest this money back into the business, into the transition into more carbon neutrality, which proves to be more promising for their future outlook. And you can get a free share worth up to £100 when you deposit just £1 using my Trading 212 link in the description down below or the promo code at the bottom right of the video. Free share worth up to £100 for just £1. Why not? When looking at the balance sheet of Royal Dutch Shell, we can see that it's good but not great. This is because their short-term assets do outweigh their short-term liabilities, but not their long-term liabilities. Although their debt to equity ratio is moderate, and it is a lot lower than some of their competitors like BP. And in fact, their debt to equity ratio has increased over the last 5 years, but this is mainly due to a reduction in overall equity rather than the overall debt loads increasing. They do have a cash position of over $35 billion, and this is only less than half of their overall debt, but then this can also be redeemed when we look at their free cash flow, which effectively could cover 50% of the debt, although this is unrealistic and more of a theoretical opinion. Much like my thoughts on BP, I don't think Shell is without their risks. While Shell arguably has a much better balance sheet than BP, they still have some issues with this sector, and that's the idea that they are so heavily tied to the commodity of oil in which they cannot control the price of it. This means that they cannot really organically grow their revenue or earnings, at least at the moment, with just selling oil by the barrel or their side products, simply because competitive pricing is so tough in an oligopoly. Instead of being able to offer more value in their products and therefore charge a higher price or offer more of a discount, they really can't do this in this situation, and it means they may rely more on inorganic growth, such as the rising price of this asset of oil, or rather the acquisition and merging of smaller oil companies in which this could present an opportunity. They have so much capital available that they could use this to therefore buy smaller, maybe more struggling oil and gas companies and use that towards further growth potential. But they could also use this cash to invest in that new energy segment, which could also mean they buy more renewable, such as wind or solar farm. But the issue is with that oil commodity asset that if the outlook is gloomier, the asset is likely to decrease, and if there's a lot of geopolitical tension, which there is quite a bit of at the moment, this could also be a factor pushing the price down. However, this depends on your beliefs of the future. If in the future you feel that as a world we will become much more stronger, more diplomatically united, then perhaps this could be a good investment as it's very heavily tied to macroeconomics. My biggest concern with the business is not necessarily the business themselves, but perhaps the management. And there's a lot of pressure in the transition from more oil and gas to more of a carbon neutrality. They had set targets earlier before the pandemic that they would like to reduce their carbon emissions compared to 2016 carbon emissions in 2050 by 65%. But with the UK setting out such legislations such as banning the use of petroleum cars or vans by 2030, I think this puts a lot of pressure on the transition. Obviously, this isn't going to happen overnight, and this business isn't suddenly just going to go, there's no more oil available. But rather, I think there'll be a lot of pressure on a management to learn and develop a new revenue stream that perhaps they may not be that experienced with. And that's where the uncertainty comes in. But with that uncertainty, the market would have priced this stock at a much lower valuation, which you're seeing right now. Whilst sure, currently, yeah, it is at a higher price than it was a few months ago, in a few years or maybe 15 years time, would it really matter if the share price was £9 per share or £13 per share when potentially the share could be well into the 100s? I don't doubt Shell can transition their business into a more carbon neutral position, although I have some concerns around it, as I mentioned. But this is further fueled by the fact that several clean energy executives had left the company prior to their update on their clean energy announcement. This could pose some concerns as if maybe Shell isn't transitioning as fast as we hoped, although this last bit is mainly speculation on my behalf. If you had owned shares of Shell in the last 5 years, you would have got returns of 16% with dividends reinvested, which is effectively trading capital depreciation for slightly more dividend income, which personally isn't something I like to see in my investments. At the very least, I'd like to see my capital preserved just above inflation with growing dividend income. But as I said, this could also pose as an opportunity to buy. After all, I'm a long-term investor, and this could be a speculative play that you put a small proportion of your portfolio into, and then you may see the returns of the recovery of the oil industry and therefore boost up your overall returns whilst also getting a strong yield on cost that is likely to be grown upon in the next few years. Therefore, I think it would be more fitting for someone nearing the age of retirement. They could use this potential or slightly more growth potential or recovery of their share price to therefore boost up their returns and generate more capital, but at the same time giving them a more consistent dividend yield that they could continue to hold whilst in retirement, and hopefully, as if they do keep growing that dividend, it could be a reliable dividend payer. And after all, if they're able to at least maintain their dividend and grow it above the rate of inflation, which the Bank of England sets a target of 2%, then this could be a staple in an income portfolio. I personally held shares of Shell in the past. I decided to cut my losses at £12 per share. I'd bought around £13 per share, so it was only a 2-month hold because I didn't thoroughly understand the business, and now I'm less confident on that transition period. I don't doubt this transition could be successful, but I'd rather invest in a business that I could more or less understand and see long-term growth potential without a massive transition. Furthermore, I believe there's better companies that you could invest your hard-earned money into, and I don't think the oil and gas industry is really one to go for, and it's more of an old world industry. Although when looking at this industry, I think Shell and BP are much better placed than a lot of their competitors, and especially when we consider the smaller cap, more speculative oil and gas companies that could be at risk of going bankrupt, I think you really can't go too wrong with these investments. If you're interested in my BP stock analysis, then click the card at the top right of the video. Thank you for watching. I'm Osborne Foreman. Have a great day.